to this webinar on identifying risks and opportunities, the role of disclosure in a changing climate, brought to you by ThinkStep and Suncorp New Zealand. We'd just like to start with an acknowledgement of country as a trans-Tasman organisation. So as we come together to share knowledge, we recognise that Indigenous peoples in Australia and Aotearoa New Zealand have been observing, understanding and caring for the environment for many generations. I'd just like to start very briefly with a couple of slides around climate risk and why it seems to be, what we call in risk management terms, a grey rhino. So this is a risk that is obvious, but it's ignored. Michelle Wuka has an excellent book on this topic and looks at why a grey rhino is a 2-ton horny thing that's coming right at you, and you have a choice to do something about it or not. And that's a metaphor for the fact that so many of the things that go wrong in business, in policy, but also in our personal lives are avoidable. We don't pay enough attention to the big obvious problems that are in front of us. And she goes on to explain why that is the case. And it's basically down to cognitive bias. We are all full of various biases. And there's just a few examples here, and there are more that are kind of relevant to the space of climate risk assessment. The first one there, optimism bias. I think anybody who works in the sustainability field has to be an eternal optimist. So I am definitely guilty of optimism bias when I'm looking at these things. But there's also other elements that actually come to light when you actually start looking at a climate risk assessment within an organization, groupthink, confirmation bias, etc. So what can we actually do about it as sustainability professionals moving and working more in this area of risk management? And it's actually about fostering a proactive risk management culture. So it's recognizing those cognitive biases within your organization, within the people that you are working with, internal, external stakeholders. It's important that we try and encourage long-term thinking. And this is one of the biggest hurdles that we've found when looking at climate risk assessments, looking at transitions to a low carbon economy. It's actually forcing people to look beyond the normal business and financial planning time horizons. And then we just have to foster open discussions about these potential threats and engaging, external experts, people who can provide support to actually try and overcome some of these cognitive biases and move an organization forward in looking at and accepting that the grey rhino is coming and we do need to do things about it. I'm going to hand over to Ollie Pomfret. Delighted that you can join us. Ollie, you're manager at sustainability at Suncorp New Zealand. Ollie's got a background in corporate sustainability programs, climate change and risk assessment, sustainability and climate reporting, people strategy, HR, leadership, and change management. So delighted that you've been able to join us, Ollie, and to give us that perspective from the insurance sector. How are you looking at it? How are you looking at risk, long-term risk, and the sort of work that you've been involved in the insurance sector? So, Ollie, over to you.
Thank you, Martin. Kia ora koutou, everybody. I'm Oliver Pomfrett, the Sustainability Manager at Suncorp New Zealand, and that includes Vero Insurance. So that's probably the brand that you would recognise most. It's fair to say climate disclosure is getting some could say a bad rap at the moment. Some would describe it as a costly waste of time or a compliance burden. But what I'm going to talk to you about today is that although it does require a lot of attention and work, there's real benefits to your organisation from disclosure and particularly in terms of how you think about your risks. At Suncorp New Zealand, we've completed our first 2 years of mandatory disclosure under the New Zealand Climate Standards. So today, what I'll do is I'll talk to you about our experience and what we've learned from that. I'll do it obviously from an insurance perspective, but I think the principles will apply regardless of what organisation you're in. In doing that, I'll cover these 4 things here. So firstly, how is climate change impacting the insurance industry? I'll talk a bit about some of the value that we identified through the disclosure process, and also the role of scenario analysis, which many of you, if you have done disclosures before, will be familiar with. And then lastly, how are we actually responding in practice to some of these risks and opportunities? To begin with, just a little bit about our business to give you some context. So Suncorp New Zealand has two main go-to-market brands, if you like. So there's Vero Insurance, and Suncorp New Zealand also owns most of AA Insurance, so 68% of AA Insurance, which probably not many people know, and that's a partnership with NZ AA. Suncorp New Zealand is also 100% owned by Suncorp Group in Australia. So we have an Australian parent entity that is also putting external disclosures into the market as a listed company over in Australia. And they are soon moving into the AASB S2 disclosure regime. So we work quite closely with our Australian parent on this as well. The company I'll talk to you about most today, though, is Vero. So in terms of our business model, it's just really useful to think about how insurance works from a business model perspective. So Vero is what we call an intermediated general insurer. And what does that mean? So intermediated means that we sell our insurance products through intermediaries, so brokers and corporate partners mainly. An example of a corporate partner would be ANZ Bank, is one of our corporate partners that we sell our products through to customers. General insurance means that mainly we insure property or liabilities. We do not provide life insurance or health insurance, although we did used to. We're a pure play general insurer now. Like all insurers, we hold a large investment portfolio to cover the liabilities, and we have reinsurance policies. So that's the insurance for us to cover us for severe, significant events, major events. So if you think about the role of insurance in the economy, to put it simply, what we do is we underwrite risk and we invest. Those are the two main activities. So if you jump to the next slide, Martin. You don't have to look very in the media to see that the insurance industry is at the front line of climate change. The insurance industry plays a really important role. So what we do is we absorb the financial shocks from extreme weather events, and we translate that physical climate risk into economic terms by paying claims. So it's really converting that physical risk into a financial dynamic. For us, climate risk is not just an environmental issue, it's actually a financial stability and social resilience issue, and that's really how we look at it. So from an insurance perspective, the topic of natural hazard resilience and climate resilience is really important to us, and it's front of mind. Jump to the next slide. So what's the role of insurance? I mean, from a customer perspective, it's really for us to be there for our customers when they need us and to help them get back on their feet financially. So that's really the primary role of insurance. But a sustainable insurance industry is also a really important part of a resilient economy. And that's another way that we look at it. So we're thinking longer term, not just about us as an entity, but how can we contribute to a sustainable insurance industry and a sustainable economy? An example of how we do that would be the anniversary weekend floods and Cyclone Gabrielle a couple of years ago. So you'll remember that. Treasury estimated that the total economic cost of that to New Zealand was between $9 and $14.5 billion. So it was one of the, or if not the most expensive severe weather event we've experienced in the country. There was $3.8 billion of insured losses, 118,000 individual claims. And if you think about $3.8 billion in claims flowing back into the economy, you can start to understand the important role that insurance plays and the impact that has. So natural hazard resilience and severe weather is something that's really closely connected to insurance. Jump to the next slide. So thinking about risk from an insurance perspective, this is how we think about it. Traditionally, New Zealand has always been known for its earthquakes and more so than its extreme weather, but climate change is making extreme weather a more important consideration for us from an insurance perspective. Following the severe weather events in 2023, the reinsurers reassessed their view of flood risk in New Zealand. And for us, for Vero as a business in financial year 2025, our reinsurance costs were 136% higher than they were 2 years prior to that. So you can just start to understand the impact that some of these changes are having on our bottom line. The map on the screen that you can see indicates how the physical risks of climate change flow through to impact general insurers' value chain. And so hopefully that shows you how climate risk manifests and impacts the business. So if you follow it from left to right, rising greenhouse gas concentrations lead to warming in the atmosphere and the oceans. This warming then drives a number of physical impacts: sea level rise, coastal erosion, wildfires, things like that. And then this has impacts, physical impacts and transition impacts on our organisation. So physical impacts is obviously increasing claims costs. We have to pay out more claims and our reinsurance costs go up. But there's also impacts from the transition to a net zero economy. And that's things like, changes in mobility, more EVs in the market, those sorts of things. So that's how we look at it. And then what we do is we think about how does that play out across our insurance portfolios and then through the various parts of our value chain. And that's really important, is to think about where the risk shows up in the organisation. And I'll just give you one example that I just mentioned was EVs, or electrification of the motor fleet in New Zealand. So obviously in the future, what we predict is there's going to be more EVs on the road and that habits will change. So there might be lower levels of vehicle ownership. There might be more public transport. That will flow through to our motor insurance portfolio and have an impact. And the part of the value chain that impacts the most will be underwriting and possibly products and services as well. So that's how we think about it in terms of what is the risk and where does it show up. Jump to the next slide. So how is climate change changing the way we operate in the insurance industry? Well, it's doing it in a number of ways. As I mentioned earlier, physical risk increases. This leads to higher claims costs and higher reinsurance costs. That flows through to affect the cost of insurance and the availability of insurance. And we see that trend continuing into the future. Risk modelling and underwriting practices are also changing with more sophisticated tools to understand and price risk. Responsible investment practices, as I mentioned, we hold a substantial investment portfolio, so where that capital is invested is also changing. And insurers are increasingly involved, or in some cases leading the conversation around climate adaptation and resilience. And so that advocacy position is really important to us as well. And then lastly, disclosure is creating a lot more transparency and accountability in this space. If you jump to the next slide, please, Martin. In terms of disclosure, which is what we're here to talk about today, as I said, it's often seen as a compliance or exercise or a reporting exercise, and yes, it is. There are standards to meet, and we have a legal obligation to disclose into the market a climate statement each year. But in reality, it's more than that. And what we've learned is that it's actually a powerful lever for organizational learning. It's also a powerful lever for resilience and for decision making. So that's what we've got out of it. I think my experience in having done this for the last 2 years inside Vero is that even just the process of documenting and disclosing your governance practices and your risk management practices and having to put that into the external market, what that does is it forces a really high level of rigor, because you can't put it out there until your board have signed it off. The board will not sign it off until management have attested to the accuracy of what you have in your report. We also have external legal reviews. We've had KPMG doing assurance over the emissions. So all of this focus and attention actually improves the quality of what you're doing. It forces you to look at your processes, your underlying processes, and really think about your risk management and how you're doing that. So that's what we've learned. There's some other benefits up on the screen there. I think the culture shift is another really interesting one. What I found is that even 2 years ago, talking about scenario analysis with people internally, you may get some blank stares when you use language like that. But now, 2 years on, having been through the process a couple of times and actually involved all parts of the business in it. You can actually just, we're through that, and people understand the language. They know what we're talking about when we talk about climate-related risks and opportunities. And the level of learning and maturity has really come on leaps and bounds. And I don't think that would have happened without mandatory disclosure. So next slide, please, Martin. Scenario analysis. So this is a process that's really core to disclosures. And if you have done disclosures before, you'll know that that's a really key part of identifying your risks and your opportunities and understanding how they manifest. The key, though, is thinking about it as a tool, and it's a tool to drive insights and understanding. And rather than doing it because you have to disclose that you've done it, I think the real benefit is doing it because you want to generate insights that add value in your organization. And if you think about it in that way, firstly, it's much easier to get buy-in and involvement across the organization because it adds value. And secondly, you can really use that information in valuable ways. Example we've got live at the moment is our board is meeting in December to do a strategic planning exercise, and I've been asked to provide some information for that session as part of their understanding of the external environment around climate risk. So I'm going to use a lot of the material that came out of our scenario analysis process for that. And that's how we start to use this information to add value in our organisation. A more recent development or disclosure requirement is transition planning and disclosing the transition aspects of your strategy. And what that is also doing is it's really encouraging us to think about how do our insights from our climate scenario analysis and our risks and our opportunities, how do they input into the business planning process and the strategy, and where does climate risk show up, and how does our strategy actually respond to that? So we don't have it perfect yet. Like a lot of organisations, we're still learning, but it's certainly a key part of the process now. So that's been really useful. Jump to the next slide. So part of scenario analysis involves considering a range of different scenarios, and you have to consider 3 of them minimum, a 1.5, a greater than 3, and some other scenario. So these are the scenario narratives we came up with that ended up in our disclosure this year. We used the ICNZ sector scenarios as the basis. So it's the Insurance Council sector scenarios that were developed a couple of years ago. We use them as the basis. So we don't just take them as read, we workshop them, and then we develop a narrative that's relevant to our business. And the narrative is really the story around what a future possible world could look like under each scenario. Then what we do is we think about the risks and the opportunities, and we essentially push play across the different scenarios and time horizons and tease out how these risks and opportunities manifest across them. And that's essentially what scenario analysis is. For us as an Australian-owned business, we also have our Australian parent doing this exercise across the Tasman. So a conversation we've got at the moment is how do we become more aligned, maybe in terms of the scenarios and the warming scenarios and the time horizons. But what we still need to do locally here in New Zealand is downscale that and make it relevant to our organisation, to essentially New Zealand. So that's still really important. So here's just a few things that came out of scenario analysis. Now, you're not required to disclose everything that you learn through the scenario analysis process, but we do include in our report some facts and figures that we think are useful for primary users of the report. Because we're an insurer, we undertake some pretty sophisticated modelling to explore how weather perils might impact our portfolios across those different warming scenarios. And I find this stuff really interesting, actually. One of the starkest statistics you can see there, it's the second bullet point, is physical risk. So if we think of the average annual loss that we pay out on portfolios across those scenarios by 2050, based on the modelling, it projects in between 19 and 26% increase in average annual insurance losses across those portfolios. But that assumes no intervention, no action. So that's, if the houses stay where they are, that's what is projected to happen. So that's really for us how we translate climate risk into business terms and financial terms across our portfolios. So we jump to the next slide. In terms of how we respond to climate-related risks, you can see the risks on the left-hand side. These are the risks that we disclosed in our report. Now, there's more detail in the actual report if you want to go and have a look, but those are the headings. And then on the right-hand side, these are the ways that we respond in our organisation. A particular focus for us is developing more sophisticated pricing and underwriting tools, because that's such a key part of what insurance is. It's about understanding risk and pricing for it. So the better we can do that, the better that we can manage our physical risks, essentially. And another real key focus for us is advocacy. And I'll give you an example. In Auckland, more than 4,000 homes have been consented in floodplains since the 2023 weather events. So that's obviously, from an insurance perspective, that's something we would advocate against, but we advocate for resilient infrastructure. We advocate for building in sensible places and not in high-risk locations. And our CEO and others are working with local government and central government to contribute to that conversation. So that's something that we'll continue to do in the future. You jump to the next slide. So lastly, I mean, these are the key, if you want to look at any of the slides, this is probably the main one, the most useful. These are the key things that we learnt over the last 2 years of doing this. The first one I would say is understand and map your value chain. So really think about where risks emerge and how they manifest and which parts of the business. And when you do that, involve those parts of the business in the conversation. It's not something you can do as a sustainability professional sitting at your desk. You have to workshop it. You have to sit down and meet with the people in the business teams and the risk function and the finance function, wherever it might be. So that's the first thing. The second thing would be scenario analysis is a tool that creates insights. So use those insights to add value in your business and think about, how can the outputs of that process flow into business planning? How can it inform how we manage our portfolios, that sort of thing. Thirdly would be integrate your climate risks with your risk management processes. And it would be fair to say in the first year, it sat alongside it. It was new, and thinking about climate risk was a bit different because you're thinking on much longer timescales with high degrees of uncertainty. But in reality, climate risk needs a risk control. It needs owners in the organisation assigned to it, just like any other sort of risk. So start to think about it in that way and integrate it. And then, and I talked about this earlier, connecting climate risks and opportunities with your strategic business planning process. So that's really important, and that's something that's a real focus for us right now in going into our FY26 reporting exercise. Another key point would be to use language that your board understands. So there's a lot of terminology in this whole area that is useful to sustainability professionals, but not very well understood by others necessarily. So I think use the language that your industry is already using. So is it physical climate risk, or is it natural hazard resilience? Is it just severe weather? So use the language that the business is already using. Remember opportunities. I haven't talked about opportunities today, but we also identified a number of opportunities in our exercise. It's things like, how do we align our insurance portfolios with industries and sectors that are more climate resilient? Because obviously those are the ones that are going to grow in the future. Advocacy, I talked about. What new products and services could we develop? New insurance products that respond to this changing risk profile. It's all of those sorts of things that are opportunities for the future. And then lastly, think about materiality. So the standards require us to disclose what. So we think about materiality through the lens of the primary user and what would be useful for the primary users. That's what the standards require. But I think as we get into more financial quantification of risk, and particularly anticipated risks and opportunities and quantifying those, we'll be applying more of a financial materiality lens. And what I think that is going to do is to start to narrow the focus down. And I predict that we will disclose less risks, but the most material risks to our organisation. And if I look at some other examples of disclosures in the market, I can already see that starting to happen. So those are the learnings that we drew out of the process. I hope that they're useful for you, and I'm happy to answer any questions.
Thank you so much, Ollie. We are actually over time, but I didn't want to interrupt you because it's just fascinating. Thank you so much. It's fascinating to see the perspective of the insurance sector. Without exception, every client that we've worked with has highlighted this, potential risk of insurance and insurance premiums, and how it's, there's kind of an interrelationship between the physical climate risks and that transition to a low carbon economy. So thank you so much for your time today. There is one question. Thoughts on the government raising the bar for mandatory climate disclosures from the 60 million to $1 billion? I'll just provide a very quick comment. Obviously, we've been working with clients over the past 2 years, or actually longer than that, in terms of generating climate disclosures and transition plans. Yes, the bar has been raised. Quite a few of those clients fall out of the requirement to disclose, but actually having gone through the process, as you said, Ollie, if you've gone through the process, you are identifying material risks and opportunities for your organization. They do not go away. Even though the regulatory requirement may have gone, there is still immense value in terms of continuing with the process. Ollie, any final thoughts?
Yeah, I completely agree with that. I mean, from our perspective, we're captured regardless as a large licensed insurer, so those changes don't impact us at all. I think for a number of listed entities that are already disclosing, many of them will continue to do it for the reasons you've just explained.
Excellent. Thank you, Ollie. Thank you, everyone, for your participation and staying on beyond the time. Really do appreciate it. Hope you found it an enjoyable webinar, and we look forward to hosting you all again soon.
We have many more webinar replays on a whole host of sustainability topics. You can check them out on our website and our YouTube channel.